Hello fellow traders. Today we'll cover an important technical analysis formation called the head and shoulders pattern. This formation has long been regarded as one of the most reliable signals of an upcoming reversal, particularly when markets shift from bullish to bearish behavior. Over the course of this video, we'll review what the pattern looks like and how to properly identify it when the price charts, and why it works from a behavior standpoint and how traders apply it to decision making. Today we're going to get into recognizing head and shoulders patterns by Pajama Trader. Let's get into it. What is head and shoulders patterns? The head and shoulders is a reversal formation that typically appears after a strong uptrend. It can be made up of three distinct pinks. First, the rise at the moderate high, known as the left shoulder, and this is followed by a sharp rally that extends higher than the shoulder, forming the head. Finally, the market rallies again but reaches a lower high compared to the head, producing the right shoulder. At the base of the shoulders of the head lies the neckline, a line that support that plays a decisive role when the pattern confirms. This structure represents fading momentum. The left shoulder reflects the first sign of resistance, and the head signals one of the final bursts of buying enthusiasm. But the inability to reach a higher point in the right shoulder shows the demand is weakening. The neckline becomes the level everyone's watching. Once broken, it signals a loss of upward control. The anatomy of the pattern. The left shoulder begins when the price rallies upwards, peaks, and then pulls back slightly. The head follows as price surges beyond the previous high but soon retreats. The right shoulder forms when the price attempts another rally but only produces a peak that is lower than the head. While it's common for the two shoulders to appear at nearly the same level, symmetry isn't a strict requirement. What matters most is the psychological story behind the pattern. Each successive peak reveals buying strength as it is weakening. Institutional investors and large traders may be exiting, and sellers are starting to dominate. This anatomy tells the story of the tug-of-war between buyers and sellers. Buyers push strongly in the head phase, but the right shoulder shows serious exhaustion in demand, and by this stage, sellers are becoming more aggressive, setting up for eventual breakdown. The neckline. The neckline is drawn by connecting two of the lowest points between the shoulders and the head. It represents a level of support that holds the structure together while it develops. When the neckline is eventually broken, the market shifts decisively. This breakdown marks the confirmation of a bearish trend reversal. The neckline can appear flat, descending, or slightly ascending, while horizontal descending necklines tend to be stronger signals. Ascending necklines are possible, but often viewed with more caution. The neckline is the foundation of the pattern. As long as the price respects it, the uptrend isn't truly broken. But once the price closes below the neckline, traders view it as a green light for bearish momentum. Think of that as a dam that once breached allows selling pressure to flow quickly. Confirmation and trade signal. Head and shoulders is not considered confirmed until the price closes decisively below the neckline. This confirmation is often accompanied by notable increases in trading volume, which validates the strength of the move. Traders frequently set projected targets by measuring distance from the top of the head down to the neckline and then applying that distance downward from the point of the breakout. Some traders prefer to wait for a retest of the neckline from below, where prior support often becomes new resistance before entering into the position. Without a neckline break, there's no confirmation trade. Strong volume increases confidence in the validity of the signal. The simple time-tested method to set downside targets is measured move. The distance from the head to the neckline projected down to after the break. More conservative traders often wait for a retest of the neckline before the market frequently comes back to test this new resistance level before driving lower. real example of Apple. Go over a live example of a head and shoulders. In this play, you see the left shoulder forming around this 230, 235 area. And then you see the top part. Well, I guess this would be sort of the neck area here, and this would be sort of the top or the head. And then getting down to 248, 247 would be the right shoulder, pretty much in this area. And then you can see that basically once it was done fading, it reached the bottom here and recovered. But most importantly, when you see this pattern, you see the left shoulder and then you see this run up here, then you'll start looking for volume to start lessening. And that'll kind of give you an idea that it's starting to fade like it did here. And then you'll see a confirmation here, which looks sort of like a doji. And once you get that confirmation, you know that you can go in because you can play against these resistance levels. And then ultimately, it wound up having a nice little fade and now getting ready to recover, to get ready to test these levels. In this Apple example, we see the pattern in action. The first peak was around 230 and forms the left shoulder. Then the stock rallies at a high of 258.18, forming the head. And the later rally fades around 247, producing the right shoulder. Once the neckline gave way, Apple stock broke sharply lower, dropping quickly around 184. This pattern successfully signaled the coming reversal. This example demonstrates why this formation is so respected. Anyone recognizing the development of the head and shoulders in real time could have anticipated the downturn and planned trades with the strong risk to reward scenario. Common mistakes and false signals. Many traders mistakenly enter the trade before the neckline is actually broken, leading to premature losses. Others ignore the role of the volume, the weak volume, and that may signal the pattern lacks conviction. Misidentification also creates problems, since sideways consolidations or triple tops may appear similar but lack psychological dynamics of a true head and shoulders. A rising neckline makes the bearish signal less reliable, and traders should be cautious when interpreting the patterns on very short time frames that may simply reflect market noise rather than a true reversal. It's easy to see head and shoulders everywhere, but discipline is critical. If the price never breaks the neckline, the pattern remains incomplete. Traders must differentiate between the genuine reversals and the simple choppy moves. Respect for confirmation separates professionals from amateurs. Trading strategies. A classic strategy is to enter, short, or sell after the market closes below the neckline. Stop loss protection is normally set just above the right shoulder to minimize the risk if the pattern fails. The projected target is set by measuring the head to neckline distance and applying to the downside. While some traders hunt for the entire target, they may prefer to scale out of the positions gradually to lock in profits as the move develops. Reliability increases when the head and shoulders is used alongside other tools, such as the RSI divergence or MACD crossovers or key moving averages. The beauty of this setup is that it provides a clear blueprint, entry risk, and target levels are defined. Traders can adapt by locking in profits progressively and supporting their decisions with technical indicators for additional confirmation. Inverse head and shoulders. The exact reverse, this is the inverse of the head and shoulders, which appears often after a prolonged downtrend. Instead of peaks, the structure forms troughs, a left shoulder with a low followed by a deeper trough forming the head, then another higher low creating the right shoulder. This neckline transforms into a level of resistance, and once broken to the upside, it serves as confirmation for a bullish reversal. The target projection is equivalent to the distance from the head to the neckline projected upward. The inverse variation demonstrates how flexible the pattern is. When flipped, it becomes a bullish reversal signal, signaling the traders to recognize early signs that a downtrend has bottomed out and a rally is emerging. Final takeaways. The head and shoulders is one of the most respected and reliable patterns in technical analysis. It reflects exhaustion of buyers after an extended uptrend, and once the neckline is broken with volume, and the reversal is often underway. Price targets are derived mathematically from the height to the head projected below the neckline. Traders should remain alert to false signals and use patience in waiting for confirmation, and pair this strategy with solid risk management practices. The inverse head and shoulders offers the same logic for spotting bullish reversals at the end of downtrends. At the heart of this pattern is not just lines on a chart, but a representation of psychology at work. Buyers lose conviction, sellers take control, and the shift materializes in price. If you found value in this video, give it a like. Subscribe for more Market Edge videos like this one. And last, recognizing these setups equips traders with a crucial advantage when navigating turning points in the markets. Thanks again for watching.